Let's dive straight in because today's market action is completely defying global expectations. We're looking at a KOSPI that just rose 0.97%, and it is a fascinating setup where extreme market concentration meets a broken decoupling. We aren't just seeing a standard upward surge here, we're witnessing highly concentrated, isolated momentum. Let's break down exactly where this capital is flowing and why it matters.
So, the KOSPI just closed up nearly 1%, and in doing so, it blasted right through some key resistance levels to establish a massive floor of support. And this isn't just retail noise. No way. This is serious, heavy-hitting institutional positioning. But the real story? It's hiding under the hood of the index.
Because this is not your typical broad market rally. Not at all. What we are looking at is extreme market concentration. Just a handful of heavyweight sectors are acting like gravitational black holes, literally pulling the entire index upward. Liquidity is laser-focused on specific areas of fundamental dominance. And the absolute center of that gravity? The tech giants. Samsung is up 3.41% and SK Hynix is up 3.48%. This is driven entirely by their absolute dominance in the HBM3E memory chip race. We all know this isn't just everyday silicon anymore. This is the essential hardware powering global AI, and the market is aggressively pricing in their capacity to physically produce it.
Think about it. You can't run global AI models on thin air, right? It requires massive institutional infrastructure, like Samsung's Digital City. This incredible capital inflow proves a vital point for today's market. Physical manufacturing capacity, not just software code, is commanding the ultimate tech premium right now. Which brings us to a timeless and honestly fascinating market phenomenon, the broken decoupling. Imagine a local market simply ignoring global macroeconomic gravity. It happens when extreme fundamental strength in isolated domestic sectors becomes so incredibly powerful, it entirely overrides broader global market trends. So where else are we seeing this gravity-defying fundamental strength? Heavy industry for sure. Shipbuilders like Hanwha Ocean are redlining at absolute maximum capacity. Dry docks are overflowing and steel is moving at breakneck speed. This isn't a future projection. This is tangible output happening right now. Just look at Hyundai. They are rapidly deploying next-generation feeder vessels out to sea to satisfy incredibly stacked order books. That fabled shipbuilding supercycle? It's not just a forecast anymore. It's a physical reality, and massive exports are physically anchoring the structural decoupling. And the sheer volume of export logistics flowing right out of hubs like Busan Port completely confirms this momentum. Institutional capital is backing tangible output because the world desperately needs these heavy industry products, and domestic capacity is being completely maxed out to deliver them. But here's the thing, you cannot run an industrial supercycle without serious power. This entire boom is underscored by massive energy infrastructure, like Doosan Enerbility's 380 megawatt gas turbines. Energy is quietly providing that structural, high-voltage baseline required to secure the modern supply chain. Beyond energy, global defense has rapidly transformed into a structural economic pillar. Hanwha Aerospace's K9 artillery is rolling straight off the domestic assembly line and into global deployment. The world's sudden demand for physical security is translating directly into heavy manufacturing output. This hardware represents an evolutionary leap in firepower. But financially speaking, what's the real takeaway? It means they're locking in long-term, incredibly high-margin international defense contracts. This predictable, highly lucrative revenue creates a massive solid floor of support for the broader domestic index. And speaking of high margins, we absolutely have to talk about the auto sector, which is compounding earnings at an incredible rate. Premium vehicles like the Hyundai Palisade are aggressively eating up market share. They're completely dominating global roads and acting as absolute cash-generating engines right now. And they aren't just sitting on that cash either. Those profits from traditional internal combustion engines are aggressively bankrolling the EV transition. You can see this perfectly demonstrated by the rollout of the flagship Ioniq 9. But wait, they aren't stopping at cars. They're already actively pivoting that massive auto capital directly into human-centered AI robotics slated for 2026. It's kind of a brilliant self-sustaining loop. High-margin hardware funds EV expansion, which in turn bankrolls the entire AI robotic future. So when we step back and pull all these threads together, the broken decoupling makes perfect sense.
We have immense, concentrated liquidity pouring into tech, we have a rock-solid floor built by shipbuilding supercycles, and we have incredible structural resilience powered by high-margin auto and defense exports. The strength might be isolated, but its overall impact? Absolutely undeniable. The real question you have to ask yourself today is this: is this broken decoupling just a temporary market anomaly, or are we witnessing the birth of a totally new global economic hierarchy where physical manufacturing completely dictates market gravity? If you would like to receive news on the closing of Asian stock markets before the New York stock market even opens, please make sure to subscribe.